Howdy, Jacob here. Today we're looking at Qurate Retail. We're going to do a more in-depth analysis on this. I believe we reviewed in the last week or two. I read through their 10Q and quarterly reports, 10K, um, and I just want to go over some of my findings. Just want to say that this is my perspective. Do what you want with it. My goal is for you to review in conjunction with your own analysis. But I do want to start by reviewing some of the financials here. So, a $500 million market cap on $4 billion enterprise value in the internet and direct marketing retail business. Revenue went up went up pretty well, pretty quick before COVID, and then since COVID actually has dropped pretty substantially. Their balance sheet has quite a bit of debt. $4.7 billion long-term debt, 642 million short-term debt on 1.1 billion cash on hand. Cash flow wise, they do produce a good amount of cash flow with their use of cash flow. Uh, recently buying back debt, which is good to see. But before they're repurchasing a lot of shares, paying a little bit of a dividend. And so let's go to some of the notes that I wrote down. So I did say I like the CEO states early on in the most recent quarterly report that they increased free cash flow and reduced debt. My biggest thing that I want for companies is to produce a stupendous amount of free cash flow, gushing like crazy. And in this company's case, I do want them to be repurchasing debt. So that was a very good thing to see that the CEO is stating the same thing that I want them to be doing. They reduced debt by nearly $1 billion in the most recent year. That is incredibly impressive. It makes sense. They do produce a lot of free cash flow, and so they're saying that until they get this cash flow debt situation figured out, they are just bamboozling their debt. QVC is one of their three main branches, and they mainly sell products socially. So I found this interesting. So it said that their competitors were mainly a Walmart and Amazon, but the products are more bougie. I can't think of the word right now. They're higher end products that they usually promote through maybe a celebrity showing off bling or showing off because home was a big part of their sales, and so maybe they're celebrities showing off their living room or something. I don't know, just something I wanted to point out I thought was interesting. The second part of their business is a program that has interactive shopping. Basically, they they uh, they show through broadcast some of their products, and then they have ways of interacting the client with or their possible customer with the actual product. Their merch mix for QVC is about 40% home, 18% apparel, 17% beauty, 25% other. 90% of shipped sales came from repeat customers over the past year, and no customer makes up a significant portion of the revenue. So good to see that. Losing one customer won't be huge for them. It's not like they're dealing with manufacturers or I cannot think of the word now, but warehouses or stuff that purchases a lot of their uh, products. It's just a bunch of smaller customers, it seems like, which is good to see. And 90% of them being repeat customers is a pretty impressive feat. However, they did have 10% revenue decline in 2023 compared to 2022. We did see that post COVID. There was actually a small jump from COVID, way smaller than what I would have thought for this type of business in the online retail. But yeah, big decline recently. Their international makes up 22% of revenue and had the slowest decline of 3% with the best operating margin. So I do want to point out that 3% decline is pretty tough, being their best performing revenue segment. But the fact that it has the biggest margins and is the declining least, I guess, is a pretty big positive. The primary source of cash in the most recent 12 months was about 280 million in insurance proceeds and 208 million of sale of assets, fixed assets. So I found that interesting. They expect to pay off all of their 2024 debt within on March 28th, 2024. So that would be all their 2024 debt. And then below, I have that their debt has 426 million in 1 year. Again, they said they want to pay that all off in the next month. 1.4 billion in 2 3 years, 1.1 billion 4 to 5 years, and then 3 billion after 5 years. So again, they do have a lot of debt, but um, you're going to have to balance out your estimation of free cash flow with how much debt they have due recently, um, which there is a good amount of debt. I mean, within 5 years, you have over $3 billion in debt. So that's going to be everything they have in cash flow, free cash flow going towards this, and they might have to sell off assets like they've done. But in the last 3 years, almost $1 billion was made from selling off fixed assets. So again, they know that their debt situation is bad, and they're trying to fix it by paying that debt down as much as possible. So a good amount of payments made to non-controlling interest due to agreements. So I did just point that out that if you look through their uh, even just income statement, you see a lot of negative incomes going out to, or a lot of income going out to non-controlling individuals, whether that be through debt and indentures or whatnot, or maybe just even agreements with broadcasts. I remember seeing that they had to pay 5% of revenues um, for uh, the Comcast or whoever was broadcasting their products. Nearly all remaining cash after required obligations is going towards debt reduction, as you can absolutely see. And then I did just point out one thing because it is currently $1.26 that it is in the Nasdaq, and you can't be um, under $1 a share. So this is just adding an extra risk factor for you to consider if you're thinking about investing. Because again, investing is not all about the numbers. You can get numbers to make sense, absolutely, but then from a present value standpoint, but you have to also take into consideration the story and is it absolutely worth it? I do think everything has a value, but I think that um, some of those risk factors you have to take into consideration a lot more than others that don't have to do exactly with present value of free cash flow and earnings. And so I did tweak my assumptions a little bit. I think it's still going to say that it's a buy, but again, you're going to have to balance this out with um, please do your own analysis, and this is just my perspective. I'm not saying I'm buying here. I think that there are a lot of risks here that aren't shown on this present value calculation. I think that that debt situation, having that much debt due in a short term, is pretty concerning to me. The fact that they have to sell off assets is likely going to increase their revenue decline even more, and so it's really just it's almost worth it to look at some of parts and see what it is to sell them all off. Because we do see, I mean, price to book is 1.0. So maybe there's gets a time where their assets minus liabilities get to a zero point 0.4 or whatever price to book, and then that maybe it's more attractive. Again, I think I'm also concerned with the fact that on NASDAQ you have to be selling for at least $1, or um, you could fall out of uh, you could fall out of compliance. And if you do fall out of compliance, then I'm even more concerned because then they don't have all the SEC rules of uh, needing to get accounted for, and then it becomes almost similar to a foreign company with when you really just have to trust the numbers being right instead of being very confident due to accounting and then having to review the numbers. Not just you can just be spewing out bush league. I mean, again, you can tweak those numbers. Uh, it's not impossible to fabricate some things, but in reality, yeah, there's just a lot of risks that come with it. So hopefully you think through it if you're thinking about investing it. I think that you could absolutely make sense with this valuation. You just have to, in your own perspective, balance out the risks with the reward. So hopefully you enjoy the video and have a great rest of your day. Thank you.